Today, we look at 3 software stocks. All are down over 15% this year, but every single one of them reported growing earnings. The free cash flow nearly doubled at one. AI customers are up 130% at another. We have record backlogs at all 3. So why is the market pricing SAP, ServiceNow and Constellation Software like their business model is dying? Wall Street made one mistake, and this gives rational investors a huge opportunity. So when we compare the performance of these companies to the general market, all 3 are down by well over 15% since the beginning of the year. The S&P 500 in comparison is up by almost 10% in the same time. So these stocks have massively underperformed the broader market. The trigger for the sell-off was that Anthropic introduced their new Opus models with the agentic Teams functionality, which made AI agents very powerful and easy to use in February. This caused a widespread panic that AI might replace traditional software or at least disrupt the SaaS business model. And for some companies, this fear was right. Figma, for example, dropped by 80%, HubSpot by 73%, Monday.com by 77% and Duolingo by 72% because these companies are working in areas that AI agents can do now. But AI is going to eat software was never really one fear. Look a bit deeper and it's actually 3 concerns. The seat-based pricing collapses because an agent does the job that one or even multiple humans had to log in before. Then the disruption of the mode of some companies because AI can code cheaper and faster than humans. And the interface itself gets disrupted because an agent skips the app and just executes the task directly in the backend. And SAP, ServiceNow and Constellation got priced as if all 3 of these risks applied to them. But in reality, each of them has already a working answer to these risks. For example, token-based invoicing instead of seats, data security and liability trust instead of clonable code, and becoming the layer an AI agent has to pass through instead of just the UI a person clicks on. This shows in the numbers, because so far the earnings of these software companies haven't been falling. In fact, they kept on growing. And recent market research still shows a generally healthy market. The broader software market is still expected to grow by around 11% until 2030. And the SaaS market even quicker with growth rates of up to 18.7% until 2034. So let's have a closer look at all of them and let's start with the one that everyone trusts less than they should. SAP. Their free cash flow more than doubled last year, from 4.5 billion to almost 10 billion euros in 2025. And the forecast for this year shows an increase of 15% again. And for the operating profit, the picture looks the same. Yet the stock fell over 45% in the last year, while the broader German market, the DAX, only fell 2%, and the Nasdaq even rose 28%. That gap between fundamentals and price is the trust problem in one chart. A business that's actually getting better, but a price like it's getting worse. But what is SAP actually doing? SAP is a German multinational corporation and the global leader in enterprise resource planning, or ERP systems. So when a factory knows exactly how many parts are sitting in a loading dock in Rotterdam, or a supplier gets paid automatically the second a delivery scans as received, there is a good chance SAP is the system running underneath all of it. It's not a product people use, it's the plumbing a company runs on and deeply integrated into the core operations of a company. Replacing SAP isn't a simple software swap. This would mean a multi-year project that touches every single department in the company. But let's walk through the 3 fears from a minute ago, one at a time, and see what SAP actually does to mitigate these risks. First, seat-based pricing collapsing. SAP already stopped billing its AI layer by seat. Joule, their AI copilot, charges by AI units, the volume of work actually performed, whether a person or an agent triggers it. That total cloud backlog grew 20% in the first quarter to 22 billion. That's the token-based invoicing answer, already live. And their software getting cloned? That's pretty much impossible. An AI knockoff wouldn't have access to 2 decades of compliance history, and no CFO is going to bet their filings on a system that isn't compliant with all regulations. The trust in that record, as well as the data security, is the mode, not the code base itself. And the interface getting skipped? This is the one SAP moved on most recently. Just earlier in July, they acquired Dreamio, a data lakehouse platform that lets a company query its SAP data and its non-SAP data together in real time without moving either. So every AI agent a company deploys has to come through the data governed by SAP to do anything useful. And the numbers prove this. They have negative debt, 19.5 times interest coverage with high margins across the board, as you would expect from a SaaS company. In fact, if you look at the margin development over the last quarters, we see that the gross margin, operating and EBITDA margins are all still increasing. So there is no sign of any AI disruption for now. They are also using their spare cash to increase the shareholder yield. SAP's management authorized a 10 billion euro buyback program running through to 2027 in January. Overall, my scoring system gives them a score of 6.4 and 7 out of 10, with only the valuation and momentum score dragging the overall score down. That's mostly because of the bad recent performance of the stock. And when we compare the valuation with their own history, here the trailing numbers, we see that the company is currently the cheapest it has been in the last 5 years. And the picture is also pretty similar in the forward-looking metrics. The forward-looking PE, for example, is at only 18.8 times, which is also very close to the lowest levels of the last 5 years. But that doesn't mean that the company is without risks. So what's the catch? One common risk for software companies is often a high stock-based compensation that eats into the free cash flow and, in the end, shareholder returns. And for SAP, we also see that. The stock-based compensation, here the orange bars, made up 20% of the free cash flow last year, which is significant. But we also see that they have decreased this from the levels from 2023 and 2024, which is a good sign. But coming back to our AI disruption that caused the stock price to crash. To me, it rather looks like SAP will profit from the move to AI agents instead of being disrupted by it. And analysts seem to share the same thoughts. They see an average 1-year upside of the stock of over 51%, with the highest price target being 140% above today's price. This estimation comes with an EPS forecast of 15.8% growth and a revenue growth of 10.8% over the next 3 years. So the overall picture for SAP looks pretty bullish. The question now is whether a company that's growing even faster can say the same thing. Which brings me to our next company, ServiceNow. Their revenue grew by 21% from 11 billion to 13.3 billion last year. When we compare this to where the company was 5 years ago, the revenue has even tripled since then. And the free cash flow picture looks pretty much the same. Just in the last year, the company grew their free cash flow by 25%. And the overall picture looks very nice. This is a company that could grow their top line as well as the bottom line with double-digit CAGRs over the last 10 years. To achieve this growth, ServiceNow is specializing in digital workflow automation across IT, HR, and customer service, mostly targeted at big Fortune 500 companies. That means that every time a new employee starts at these companies, ServiceNow can handle the whole process from issuing the ticket for a new laptop with IT, getting building access rights with security, and establishing the paycheck with finance. And with their AI control tower, they already have integrated AI agents into these workflows to orchestrate whole operations. Similar to SAP, they provide a mission-critical software that is deeply integrated into the workflows of each company, which makes the switching costs enormous. This shows in the industry-leading retention rate of around 97 to 98%. So once a customer uses ServiceNow, they very rarely leave it. When we look at the rule of 40 that combines the free cash flow margin with the revenue growth, we see that ServiceNow can easily beat the threshold of 40% with a value of 54% here, and they also beat SAP. Now, SAP is a much bigger and more mature company than ServiceNow, so take the gap with a grain of salt. But it shows that we have a high-quality compounder on our hands. Now, when we look at our 3 AI disruption fears again, the company appears even stronger, not weaker. ServiceNow's new business is already non-seat based. It's priced on consumption tokens and digital assets instead of users. And customer spending over $1 million per year on the Now Assist AI suite grew more than 130% year over year. That is far from a decline or business model disruption. In fact, this growth came despite AI agents doing more of the actual work and is a clear sign that they can directly benefit from this trend. So, what about their software or mode getting cloned by AI? Well, ServiceNow's real asset is its configuration management database. This is essentially the map of every system, dependency, and process running inside a company which took years to build. A generic AI agent doesn't have this map or the data and doesn't know how the business actually fits together and can't just clone this reliably. ServiceNow is also leaning into the delivery via agents rather than fighting it and insisting on their own UI. Its AI control tower now governs agents built on Microsoft's own Agent 365 platform. So the agent doesn't replace the UI. It reports through it. In my own scoring system, the health and profitability picture backs this up again. We have strong margins and a good cash generation, although not quite as great as SAP's. But even though the margins in general do look quite good, the gross margins have still compressed for the last 4 quarters straight and are down 5% compared to 2024. This shows that running large language models in real time costs more than traditional software ever did. The company also closed the acquisition of Armis in April this year, which cost them $7.75 billion and still needs to prove that it was worth this price. Similar to SAP, ServiceNow is also paying a significant amount of stock-based compensation. In their case, this even makes up 43% of their free cash flow, which is a very significant amount. This has also led to the company diluting their own shareholders by an average of almost 0.9% per year for the last 5 years. For me, this is still within my acceptable range, but it's something to keep in mind. But similar to SAP, analysts are pretty bullish and have an average 1-year price target of $140, which is 34% above the price today. And this price target comes with double the forecasted growth rates as for SAP. ServiceNow is expected to grow the EPS by over 25% per year and their revenue by almost 20% for the next 3 years. So that's 2 companies down, with Constellation Software coming up next. But before we go there, if you like the video so far and feel like it helps your own investing, hit subscribe. I post up to 2 of these videos every single week, including deep dives like my recent deep dive for ServiceNow, for example. But next, let's look at the last company today, Constellation Software. And while SAP and ServiceNow are platforms almost everyone's heard of, Constellation Software owns hundreds of platforms that almost nobody's heard of, each built for exactly one industry. This means that somewhere right now, a municipal water utility is billing customers, our hospital is scheduling surgeries, and an airport is routing ground logistics. And the software running underneath all 3 is probably a Constellation company nobody outside of this specific industry has ever heard of. Constellation doesn't build one platform. It owns hundreds of monopolies. Each one tiny, but each one essential to the business running it. That market is called the vertical software market, and it's expected to reach almost 500 billion market size by 2034. That's an annual growth rate of almost 13%. This is also the segment that investors assume AI will kill the fastest. Because if an AI agent can write code cheaply, why not let a startup clone these niche softwares and undercut Constellation Software? So first, let's check our concerns again. The disruption of seat-based pricing doesn't really apply here because a lot of their products were never built per seat to begin with. Then we had the software mode being cloned, which is a real concern. Constellation's management addressed this at the 2027 annual shareholder meeting. Their argument is that AI makes writing the code cheaper and faster. But the code was never the hard part. The hard part is the decades of customer relationships and, again, the compliance track record and IPs. A cheap AI-coded alternative just doesn't come with the regulatory trust that hospitals or airport needs. So, what about the UI getting skipped? Well, because they have unique and segment-specific software that no one else has, even if the users are replaced by an agent, it still has to pull the data from somewhere and execute actions in the underlying system. And in that case, Constellation Software simply transitions from being accessed via an interface to being accessed via an API. In the Q1 meeting, Mark Miller, the president of the company, said that they don't see any AI-specific attrition so far. And we can see the proof in their revenue and their free cash flow. Both have been growing nicely over the last years. Over the last 5 years, Constellation could grow their revenue by a CAGR of 23.7% and their free cash flow by 11.7%. And in contrast to ServiceNow, they did this without any share dilution whatsoever. The margins, like the gross margin in blue here, also have been growing over the last 3 years, which also proves that the company has rather been increasing the moat instead of being disrupted. Only the ROIC, the return on invested capital, is going down. But this was a deliberate management decision. Because as the company grew larger in size, they also needed to make larger acquisitions to make a difference. So a couple of years ago, the management decided to lower the hurdle rate, the minimum acceptable rate of return, to compete for these larger acquisitions. And we see this now in the return of invested capital. And this is also reflected in my scoring. The company had a very high growth score, but lags behind the other twos in terms of health and profitability, because of their generally lower margins and lower ROIC. So the real risk isn't AI. But as a serious acquirer, they have to take on debt to keep on buying new companies. And while the net debt to EBITDA ratio is still pretty low, especially for such a business model, the interest coverage ratio is only at 6.4 times. And because they spread their debt across dozens of countries, they do have exchange rate effects that are pretty unpredictable. And while we're at the topic of acquisition and debt, in the first quarter of this year, they spent $685 million on new acquisitions, which was their second largest quarter ever. But this had nothing to do with AI, and as they pointed out in the earnings call, they currently see a real disconnect between private markets, where everything is business as usual, and publicly traded stuff. So, same as our other two companies, analysts are also pretty bullish for Constellation. They see an average 1-year upside of 47% with a 3-year EPS growth forecast of 47.3% and a revenue forecast of 16.8% per year. The EPS growth sounds massive, but is partially because of decline in EPS last year that came from non-cash accounting changes and had nothing to do with the operations. So overall, none of these companies is currently being disrupted by AI, and it rather looks like they can benefit from it over the long run. All of them act as toll booth for agents. SAP in data security and compliance, ServiceNow in the company's workflows and how the internal systems connect to each other, and Constellation in decades of regulatory trusts and IPs for a whole galaxy of niche industries. 3 completely different businesses with 3 different toll booths, but all are on the same road. Each of these companies built its own answer to the SaaS-pocalypse concerns years before the market panicked and priced all three for a collapse. And that's the real mispricing. The market got scared and just sold off anything with software in the name, regardless of the real business underneath. But this gives us fundamental and long-term investors a real buying opportunity. But as always, that's just my opinion. Now, I would like to know from you, what do you think about these three companies and do you own any of them? Let me know down in the comments. And if you would like to dig a bit deeper into ServiceNow to get the full picture including my concrete buy price, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys and see you in the next video.